All right. So today we are going to be dissecting the concept of business valuation. In your syllabus, you are expected to learn about merger and acquisition as a topic. You also learn business valuation. Um, it will be interesting to know that merger and acquisition is purely theoretical. There's no calculation there, right? So examiner expected or the syllabus expected you to understand the meaning of a merger, the meaning of acquisition, what are the forms of merger, what are the reasons for merger, what are the defensive tactics that acquiring firm or a target firm usually adopts, what is synergy, what are the advantages and disadvantages, what are the types of synergy. What do you understand by divestment, management buyout, management by acquisition? All these things, all these concepts, the syllabus wants you to understand them. Therefore, I will encourage you. We are not going to be discussing merger and acquisition in the class. What is merger? What is, we won't do all of that. So you already have the material. Therefore, please go ahead, go and read A to Z of merger and acquisition and form your note on them. Read it and then summarize your notes, the key points. It is that key points you are going to take to the exam hall because you never can tell. The examiner can ask you maybe as a sub requirement for you to explain the defensive tactics, for example, or you may be asked for to discuss the types of or the forms of merger or synergy. All of these things you need to know them. So please go ahead and read it through. All right. So we have major work under valuation. Margin and the calculation of margin and acquisition will be done under valuation. Okay. So and that's where we are going to start from today. As you are aware, or as we have discussed this in the past as well, business valuation is the most consistent topic in ICAN exam. It is the most frequently tested topic. There's never a diet. Since I know about ICAN, there's never a diet that ICAN will not test business valuation. That is for you to know how important, all right, the topic is. And then, of course, an average student cannot go to the exam hall without your extensive knowledge of business valuation. All right. What are different ways examiner can test you as far as valuation is concerned? All of this, you just have to know them. It is a must. It is a must that you know them, except tomorrow, if come May 20th, which should be on Wednesday, come May 20th, if ICAN does not test valuation, then I can say, okay, they've deviated from their tradition. Because as far back as 20 years ago that I know about ICAN, there is never a diet that valuation question will not be tested. If it doesn't come as a compulsory, it will come in section B. In recent time, effective 2022, effective 2022, valuation questions have been tested as compulsory for May and November diet. ICAN has never missed it for the past for 4 years now. Before, every May diet is valuation question. Every November diet is business analysis, where you have capital budgeting, right? Cost of capital, adjusted present value, all those option pricing and all of that. I can do test those every November diets. Business valuation every May diet. But since May 2022 up to date, it has always been business valuation. It has always been business valuation every diet. So We don't know what is coming, but we just have to prepare ahead of time. All right. So let's start the class with business valuation. Don't forget what I said. Please go and form your notes on merger and acquisition. Okay. So if that is the case, what do you understand by business valuation? Now, let me mention to you, we have today and next week, Tuesday, to conclude the scope of strategic financial management for this diet. But with the look of things, there is possibility that we may not be able to complete it in our next class. Because today, for example, I will take my time to explain the concept. Possibly we may solve one or two. We can't solve more than one question. So what that simply means is that because I don't want to, I'm going to give you different scenario-based questions, and we cannot, at least, we'll be able to solve between 5 and 7 different questions. All right, between 5 and 7 different questions. And these are big questions. Majority of them are big questions that can take time, all right, to solve. So I don't see us completing it next weekend, Tuesday. If not, then there's a public holiday coming on May 1st, which is on Friday. If I can spare like few hours to complete it, so be it. If not, then we can do it in a subsequent, in the following week. All right, so let's talk about valuation. Please open to your material at your end. In order to cover as much as possible, I will just talk through the key things that you need to take into consideration. All right. So what do you mean by valuation? Valuation is the process of determining the economic worth of a business or of a company's share. Okay, the process of determining the economic worth of a business or of a company's share. Valuation can be carried out for different purposes, including one, merger and acquisition. When two businesses are coming together, there will be need to value the individual company in the merger transaction. All right. So you want to know, as the company A, what is my worth? Then company B will also determine its own value, so that at the end of the day, you'll be able to determine the combined value of the two entities. So you carry out valuation for the purpose of merger and acquisition. Number two, for stock exchange listing. If a company is going for initial public offering, for example, there may be need to value the business to be able to know how much its share price will be. All right. Then also, number three, you carry out valuation for the purpose of loan facility. If a company, depending on the size of the loan, if a company wants to access loan, maybe through a bank or investor or some investors, right? There will be need to value the business in order to determine how the business can support, or the value of the business will determine how it can support the loan that is seeking in the market. All right. Now, number four, I'm looking for, okay, where is that? I'm looking for valuation. So number four, I think, where is that again? Yeah. So number four is for litigation purposes. All right. So litigation can arise between companies, or between company and the contractor, or between principal and agent, when there's a disagreement, unresolved disputes, okay, between parties. All right. So there may be need to determine the value of the assets in question, so that in order to determine the claim settlements arising from the assets. Then another reason for valuation is for the purpose of for the purpose of liquidation. All right. So when the company liquidates, the asset of the business will be disposed of. Therefore, before the asset is being sold, you want to determine the value of the business. You want to determine the value of the business so that you'll be able to ascertain how much selling price you should seek from prospective buyers. All right. So that's one of the reasons for valuation. Not only that, you also carry out valuation where there is shareholder or partnership disputes. When partners in a partnership business have disagreements, unresolved disagreements, and you may want to determine, they may agree that it's better we dissolve the partnership business so that we can go our separate ways. All right. So before the partnership business is dissolved, you need to determine the value of the business so that you know how much should be attributable to each partner in the partnership business. Now, the next one is where there's marital disputes. All right, this is not common. This is not common in Africa, for example. All right, it's not common in Africa. All right. So this is very common in Europe, whereby if there is a marital dispute between two couples and one of them has taken the other party to court, so the court may decide that we need to determine the value of the estate of either of the parties. All right, so that we'll be able to know how much will be shared or attributable to the other party from the estate of the partner with a higher value. All right. If the wife has a higher value relative to the husband, the asset of the wife will be shared depending on the ratio that the court determines. If it is the man's assets that is more than the woman, then of course the court will also decide. All right. Like I said, this is not common in Nigeria and Africa in general. If for some of you that are familiar, that are very social, you will notice that most of the world richest people at one time in the past dissolve or divorce their spouse. For example, Elon Musk is the richest person in the world. He divorced his wife. What's his name? This guy of Amazon, Jeff Bezos, the same thing. Bill Gates, almost all of them, they've done it in the past. All right. So these are some of the reasons for valuation. Now, what are the methods of value? In fact, let me stop this. You can open to this material at your end. It's distracting me. So let me just use my working note to do whatever the explanation I want to do. So what are the methods of valuation? Basically, there are so many methods of valuation, but we are going to restrict it to 3. Number A, let me just, methods of valuation. Number A, you can use asset-based approach. Asset-based approach. Now, the asset-based approach is a method of valuation that relies heavily on the use of net assets. For this purpose, the value of a business using asset-based approach represents the net assets. And net assets is the difference between total tangible assets and total liability. I repeat, the value of a business using asset-based approach represents the difference between total tangible assets and total liability. Tangible assets are those assets that can be seen, touched, and move around. All right. For example, landed property, building, motor vehicle, machinery, equipment, all those are tangible assets. You can see it, you can feel it, you can move it around, okay? Intangible assets are those assets that cannot be seen or touched or move around. For example, you have goodwill, you have patent rights, you have copyright. Those are intangible assets. Therefore, when valuing a business using asset-based approach, only the tangible assets should be considered. Only the tangible assets should be considered. So what this simply means is that any intangible asset like goodwill, okay, like copyright or patent right should be ignored except they have a market value. Only when examiner gives to you a market value of any of those intangible assets that you can include it as part of your assets. But if you are not given the market value of the intangible asset, just ignore it, okay? So like I said, when valuing a business using asset-based approach, the value will be equal to net assets. Just go ahead and calculate net assets. Net assets is the difference between total tangible asset and total liability. Okay, so the asset-based approach will provide a minimum guide to the seller company. All right, it should provide a minimum guide. You cannot use as a standalone basis for valuation. You cannot use asset-based approach as a standalone basis for valuation. It will only give you a minimum guide as to the value of the business. All right, so you have to use asset-based in conjunction with other methods of valuation. Okay, what are the forms? What are the forms of asset-based approach? Before I go there, let me just add more. I said net assets is equal to total tangible assets minus total liability. That's it. So basically, there are four types of forms of asset-based approach. Forms of asset-based approach. At times, examiner may want you to use book value basis. Number one is book value basis. Book value is the amount represented in the statement of financial position. The figures you are given in the balance sheet, they are the book value. So if examiner wants you to use book value basis, just go to the balance sheet, the figures you have there, use it to determine the net assets. That's all. The second one is realizable value basis. The realizable value basis is how much the seller company can realize from selling the business. Okay, so again, using any of these methods, all you need to do is to just calculate net assets. Number three, replacement value basis. The replacement value basis is the amount at which similar company can be purchased or can be bought in the market. All right, the amount at which similar company can be purchased or bought in the market. That will give the replacement value. The number four is liquidation or breakup basis. So the liquidation basis is the value of a business at at disposal or at a breakup basis. What do I mean by liquidation basis? When a company wants to, when the company liquidates, the amount at which you are going to sell the asset of the business is the breakup basis. You know, you can, when you are at that point, when you are that when you are at that level, you will not be able to dispose the asset of the business at market value because the seller company is under pressure. All right, it's under a distress condition. Therefore, it will be at a kind of a giveaway prices. Just like you want to travel out of Nigeria, for example, and then you want to sell your property. You know, nobody will. People are already aware that you want to travel, so they are not going to pay you at a market price. All right. So liquidation basis will always be at a giveaway prices. All right. So these are the forms of asset-based approach. In any of the forms, all you need to do is to calculate the net assets. All right. So under each of them, examiner will give you the value of the assets at realizable basis, the value of the assets at replacement basis, the value of the asset at liquidation basis. So any of the assets that the examiner did not give you value for, then you are going to use the balance sheet value. That is, you are going to use the book value. All right. So that is how to calculate. It's very straightforward. This is how to determine the value of a business using asset-based approach. So the second one is income-based approach. The second method of valuation is income-based approach. Now, under the income-based approach, there are three components of valuation. Number one is price earning ratio. Price earnings ratio. PER. Now, let me just name all of them. So let's talk about, okay, let me name all of them. Number two, dividend yield basis. Then number three, earnings yield basis. So let's talk about each of them. The first one is price earning ratio. The price earning ratio represents the ratio of share price to earnings per share. Okay? The price earning ratio represents the ratios of share price to earnings per share. Therefore, the valuation of a business using price earning ratio is determined by multiplying the price earning ratio with the earnings. All right. Let me just put it down for you. PER, price earning ratio, is the ratio of share price to earnings per share. Therefore, the valuation of a business using PE ratio is determined by multiplying the PE ratio with the earnings. Remember, earnings is the same thing as profit after tax. With the earnings. All right, so that will give you the value of the business. Okay. Any companies can use, or let me just put it this way. Price earning ratio can be used by any company that has a profitable history, This means that any company, any loss-making company cannot use PE ratio for the purpose of valuation. All right. So only the company that has profitable history can use price earning ratio for valuation. Now, at times, examiner may want you to value a limited liability company using price earning ratio. The PE ratio is only available for quoted companies. Let me put it down for you. It should be noted that PE ratio is only available for quoted or listed companies. This means that let me reframe it. Therefore, when valuing, I said I'm not going to talk too much. When valuing an unquoted company, when valuing an unquoted company that is limited liability company, the PE ratio of a listed comparable company can be used but adjusted can be used and should be adjusted downwardly between the ratio of 10% and 50%, depending on the perceived risk associated with the unlisted company. Okay, so what we are saying is that you can only use PE ratio for a quoted profitable companies. Any company that is not quoted on stock exchange, a limited liability company does not have price earning ratio. So if you now want to value a limited liability company using PE ratio, you are going to look for a comparable quoted company that operate in the same industry with the limited liability company. So you borrow the P/E ratio of such company. However, you cannot use the exact P/E ratio of a quoted company for an unquoted company. So you have to adjust between the ratio of 10 and 50, depending on the perceived risk associated with the unquoted company. Because if you use the ratio of a listed company to value an unlisted company, what you are saying, you are assuming that both the listed company and unlisted company have similar risk, which is not true. An unquoted company is more risky relative to a quoted company. So, and that's why it is important when you are valuing a business using price earning ratio, when you are valuing a limited liability company using price earning ratio, you must adjust for the perceived risk associated with the company. So your percentage will depend on the perceived risk associated with the limited liability company. So this is what you need to do when you are valuing a business using P/E ratio. So like I said, the value of a business using P/E ratio is determined by multiplying the P/E ratio with the earnings. All right, it's as simple as that. The challenge with the P/E ratio is the fact that the challenge with this method is the fact that where you are going to struggle is your ability to be able to interpret the question, because examiner will never give to you profit after tax that is straightforward. Because profit after tax, you can easily see it in the income statement. Just multiply the P ratio with the profit after tax, you are good to go. But it doesn't work like that. Because before you arrive at the profit after tax, before you arrive at the earning, some adjustment have been made. Some accounting, some assorting accounting must have been carried out by the company, which you also known as window dressing accounting or creative accounting. All those accounting, earnings management and stuff like that, most companies do carry it out. Therefore, when you are valuing a business using P/E ratio, examiner will tell you they are going to give to you a kind of scenario that will demonstrate how to calculate your revised earnings. All right, so they will tell you that the depreciation of the assets was charged at so much instead of so much in order to reduce tax liability. You know, they will tell you that management fee of so much was charged instead of this, you know, different kind of scenario. So what the bottom line is that it's not going to be just go to the question, pick your price earning ratio, pick your profit after tax and then just multiply with price earning ratio. It doesn't work like that. You are going to make adjustment to your earnings. I've never seen any question like that where it will be very straightforward, whereby you just pick the earnings in the question and then you multiply with price earning ratio. I've never seen. So you are going to make adjustments. So watch out. So this is what you need to do under the price earning ratio. The second one is dividend yield basis. All right, dividend yield.
Please give me water. Are you carrying her? No, I'm doing her review.
Mr. Isma.
So, I'm sorry,
why are you making us in my class?
Sorry.
So for the dividend yield basis, dividend yield, let me just go straight to the point. Dividend yield is the ratio of dividend to share price. Ratio of dividend to share price. It is also known as cost of equity. Okay, that's dividend yield. Therefore, the valuation of a business using dividend yield represents the present value of future dividends discounted at the yield discounted, let me say, discounted using dividend yield or cost of equity. All right, so that is value of a business. This can be computed as follows. Depending on whether or not there is growth in dividend payments. Let me write it. Depending on whether or not there's growth in dividend payments. So you will recall that when we had cost of capital, I gave you two different formulas to calculate cost of equity, where there's growth and then where there's no growth. So where there is no growth, in dividends, so where there is no growth in dividend, we said that cost of equity, which is the same thing as dividend yield, is computed as dividend, the current dividend, divided by ex-div share price, multiplied by 100%. You remember this formula? All right. So this share price is the value per share. So if you are now asked to calculate the value of a business using dividend yield basis, all you need to do is to just cross multiply. That is, you make the share price the subject of the formula. Therefore, the market value of a business using dividend yield is computed as the ratio of dividend over dividend yield, or cost of equity. That's all. This is the market value, where dividend will remain constant to perpetuity, where there is no growth in dividend payment. This is the formula for calculating the market value of a business. But where there is growth, in dividend payments, then the formula will change slightly. Also, where there's growth in dividend payment, we said cost of equity, which is the same as dividend yield, is computed as the current dividend multiplied by 1 plus growth rate all over ex-div share price plus the growth rates. All of this multiplied by 100%. Okay, so this is the formula for calculating cost of equity. Again, you want to make the denominator the subject of the formula. You can then say the market value is computed as the current dividend multiplied by 1 plus the growth rate all over dividend yield or cost of equity. Minus the growth rate. The growth rate you have here become under, so minus G. So this is the formula for calculating the value of a business where there's growth in dividend payments. All right. So whichever one that you have on that day, if examiner wants you to use dividend valuation model or dividend yield basis, this is the formula you are going to use. If there is no growth in dividend payment, you use this one. Where there is growth in dividend payment, you use this one. The third one, number C, is earnings yield basis. Okay, earnings yield basis. This is similar to dividend yield. The only difference is just that this one is earnings. All right, so earnings yield is the ratio of earnings. Remember, earnings is the same thing as profit after tax. Ratio of earnings to share price. Whereas the valuation of a business using earnings yield basis represents the present value of future earnings that is profit after tax, discounted using earnings yield. Or rate of return on equity. All right. So it can be calculated as follows, depending on whether there is growth, whether or not there is growth. So where there is no growth in earnings, where there is no growth in earnings, earnings yield, okay, is computed as earnings divided by share price multiplied by 100%. So where there is no growth, the market value will be computed as earnings, okay, divided by earnings yield. All right, so that's that. This is not common in ICAN exam. What is common is dividend yield basis. Okay, the B parts where there is growth in earnings. So where there is growth in earnings, you can calculate earnings yield as earnings multiplied by 1 plus growth rate over share price plus the growth rates or multiply by 100%. So using this formula, market value will then be calculated as earnings multiplied by 1 plus growth rate all over earnings yield minus growth rate. So this is the formula for calculating market value of a business using earnings yield. All right. You have all of this in your learning material. Okay. So that's that about income-based approach. That's about income-based approach. So at this stage, let's go to the Oga Patapata, the most sophisticated method of valuation, which is cash flow-based approach. Remember,
Hello.
the
Hello, sir.
first one.
Hello, sir. Hello, sir.
Yes, you disrupted
Yes.
me. You should
Oh,
have raised
sorry,
your
sir.
hand.
Okay, sorry, sir. I wanted to say that before you go to the cash flow approach, this earnings yield, is it like is it related to the dividend growth model? Is it an adaptation of dividend growth model where we substitute earning for dividends?
You can
This
say
earning,
you can look you can look at it like that. Like I said, you can see it's closely related to dividend, right?
yes.
So yeah, the formula is closely related to dividend. You just substitute earnings for dividend or substitute dividend for earnings. So yeah, you can look at it in that manner, but again, just a slight difference between the two.
Okay,
So
sir.
instead of using dividend, you use earnings. Yeah. All right. So we said there are three components of income-based approach. The first one is price-earning ratio. This is what we will have here. Then the second one is dividend yield. And the third one is earnings yield. All right. So I just explained each of them. So now let's talk about discounted cash flow basis. Discounted cash flow basis, which is number C now. Discounted cash flow based approach. All right. This is a method. Let me put it down. This is a method of valuation that relies heavily on the use of free cash flow for the purpose of valuation. For the purpose of valuation. It represents the most sophisticated method of valuation. Okay, so for this purpose, free cash flow, let's define free cash flow. Free cash flow represents the cash flow available for distribution to the cash flow available for distribution to the providers of capital, including the shareholders and debt holders. After considering or after charging the operating costs and capital expenditure needed to support growth and expansion. Okay. So that is free cash flow. What are the uses of free cash flow? All right. You can use free cash flow, number one, for the purpose of merger. Let me put it this way. Free cash flow can be used for one, merger and acquisition valuation. Number two, you can use free cash flow to pay debts. Number three, free cash flow can be used for paying dividends or determining dividend capacity. Let me just mention three. Determining dividend capacity. What do you mean by dividend capacity? Notes. Dividend capacity is the ability of a company to pay dividends from the cash flow available for distribution to the equity holders. All right, so that is dividend capacity. It can be calculated as follows. So if you are asked to calculate dividend capacity, we can use the formula below to do it. So dividend capacity, just like interest cover, is the ratio of free cash flow to equity what's wrong with you know? Free cash flow, so equity over dividend. So it is measured in times. All right, so that's the formula for calculating dividend capacity. So how do you then determine free cash flow? Before that, what are the types of free cash flow? types of free cash flow. Majorly, there are two types of free cash flow. Number one, we have free cash flow to the firm. Denoted as FCFF. Number two, we also have free cash flow to equity, which is denoted as FCFE. Let's talk about each of them and the format to use. So let's start with the free cash flow to the firm. So what do you mean by free cash flow to the firm? This represents the cash flow available for distribution to equity holders and debt holders. It is useful for determining corporate or enterprise value. When you want to determine the value of a company, you use free cash flow to the firm to do it. All right. The format below. No time. Let me just format. So if you want to determine free cash flow to the firm, there are two different formats that you can use depending on the information available on the day of your exam. If in the question you are not given profit after tax, but you are given profit before interest and tax, then you can start with profit before interest and tax. So I will come here, free cash flow to the firm, starting from profit before interest and tax. All right. So if you want to start from profit before interest and tax, of course, let's say our figures are in million. You go to the question, you pick the profits before interest and tax. When you are calculating free cash flow to the firm, anything that has to do with the providers of capital, you ignore it. For example, interest expense. When you see interest expense, you ignore it. You are going to ignore dividend, any loan repayment or proceed from debt issues, so you ignore them. So anything that has to do with the providers of capital, you ignore it. You are not going to consider it in your free cash flow to the firm, because the free cash flow to the firm you are calculating is meant for distribution for those, to those providers of capital. And that's why you don't consider interest, you don't consider dividend, you don't consider loan repayment or proceed from debt issue. So immediately after profit before interest and tax, you are supposed to pay tax. So your tax will be calculated as profit before interest and tax multiplied by company tax rates. Whatever it is, you less. No need to find difference. Then you come here, you add back non-cash item like depreciation or amortization or provision. So any non-cash item, add it back. Because before you arrive at the profit after tax, profit before interest and tax, you have already charged depreciation. Depreciation is not a cash item. So that's why you have to return it. Then after depreciation, you consider changes in working capital. So if working capital decreases, it's a plus. That means more cash has come in. If working capital increases, then it's a negative. Cash has gone out. So how do you know? How would you know that? Because of time, I will use a question to demonstrate it. But for now, let's just move on. I wanted to show you how to consider changes in working capital, but we don't have time at all. So I will use an exam question to do that. Then, after changes in working capital, we consider capital expenditure. So it is possible that the company may want to purchase non-current assets. Therefore, we include it. That means cash will go out. That's the cash outflow. At the end of the day, you have your free cash flow to the firm. So this is the format for calculating free cash flow to the firm, starting from profit before interest and tax. So it is also possible in the question that you are not given profit before interest and tax. You are given profit after tax, or you are given profit before interest and tax. You are also given profit after tax. So you can decide to use any one. So if you want to start from profit after tax, you want to start your calculation from profit after tax. Again, we come here, profit after tax. Put it there. Remember, before you arrive at the profit after tax, you have deducted interest. That interest that you deduct, you need to return it because the free cash flow to the firm you want to calculate is meant for distribution to the providers of the debt capital. So you then calculate your net interest. This is computed as interest multiplied by 1 minus tax rate. So you add it back. Then you also consider you add back non-cash item, depreciation or amortization. Add it back. Then you consider changes in working capital. If your working capital decreases, then that's a plus. But if your working capital increases, that's a cash outflow. You consider capital expenditure. It's a cash outflow. Then you have your free cash flow to the firm. All right. So this is the format. These are the two formats that you can use to calculate free cash flow to the firm, depending on the information available on the day of your exam. All right. Then let's talk about free cash flow to equity. Let's talk about free cash flow to equity. So what do you mean by free cash flow to equity? The free cash flow to equity represents the cash flow available for distribution to equity holders. To equity holders. It can be used for determining equity value or market value of equity. All right. So that is free cash flow to equity. You use free cash if you want to determine equity value, you use free cash flow to equity. All right. Then how do you calculate free cash flow to equity. So free cash flow to equity, you can use these formats. I will give you 3 different formats depending on the information available. So the first one will be if in the question you are asked to calculate free cash flow to the firm, and then number B, you are not asked to calculate free cash flow to equity, or in the question, the examiner has provided you with free cash flow to the firm, right? And you want to calculate free cash flow to equity. So starting from free cash flow to the firm, then your free cash flow to equity is computed as free cash flow to the firm. Put it there. Remember, we said that the free cash flow to the firm is the cash flow available for distribution to equity holders and debt holders. You have to pay the debt holders before the equity holders. So from this, I need to pay interest. I need to pay interest. This will be net interest. All right, which is interest multiplied by 1 minus tax. So you deduct it. Any other thing that has to do with the debt holders, for example, loan repayments, maybe part of the loan that the company is owing, you want to pay back part of it. So you drop it. It's a cash outflow. It is also possible that the company has borrowed another entity loan and those entities are now paying back. That's a proceed. So you had proceed from debt issued. It's a plus. At the end of the day, you get your free cash flow to equity. So this is one way of calculating free cash flow to equity. Like I said, you only use this format if examiner has given you free cash flow to the firm, or you are previously asked to calculate free cash flow to the firm, and you are now asked to calculate free cash flow to equity. That is, you are starting from free cash flow to the firm. This is the format. The second format is starting from profit before interest and tax. Free cash flow to equity, starting from profits before interest and tax. All of these formats, you can't see it anywhere except in the Golden Book. Nobody has time to be doing all of this. Just to make life easy for students. That's why I have to develop it like that. Now, starting from profit before interest and tax, this is more like starting from the beginning. Therefore, I will then come here, profit before interest and tax. The first thing I will do is to charge interest. This is not net interest. So the entire interest given to you. So you deduct it. From this, you are going to have profits before tax. Then you charge tax, which is PBT multiplied by company tax rates. Then you add back non-cash item depreciation. Or amortization, you add it back. You consider changes in working capital. If your working capital decreases, it's a plus. If it increases, it's negative. You consider additional non-current assets. That is capital expenditure. It's a cash outflow. So you consider loan repayments. It's a cash outflow. You consider proceeds from debts issued. It's a plus. Then you add everything together. You have your free cash flow to equity. So this is another way of calculating your free cash flow to equity. All right. The last one of calculating free cash flow to equity is to start from profit after tax. So it is possible in the question you may not have profit before interest and tax. Examiner may only give you profit after tax. Therefore, starting from profit after tax, we put it there. The next one will be to add back non-cash item. This one is faster relative to starting from profit before interest and tax. Then you also consider changes in working capital. Then you consider capital expenditure, additional non-current assets, cash outflow, any loan repayments, cash outflow, proceeds from debt issued. It's a plus. Cash has come in, add it. So you have your free cash flow to equity. So these are the 3 different formats that you can use to calculate free cash flow to equity. Okay. Now, what else we want to discuss? You know, what we have been discussing under the cash flow basis are just free cash flow. Now, is whenever you are asked to value a business using cash flow based approach, is very straightforward. But the challenge with free cash flow is that you have to understand the requirement of the question. First thing first, the question will be very straightforward. Just all you need to do is to just calculate your free cash flow using any of these formats. You then discount it at the appropriate cost of capital. You are going to get market value for the initial period. That is present value for the initial period. You then calculate present value to infinity. You add the 2 present value together. You have your total present value, which represents the corporate value. You then deduct the value of the debt, that is debt value. Then you have your equity value. That's all you need to do. But the challenge with free cash flow is if it relates to business combination. Under business combination, there are some scenarios that can arise. So if you know how to deduce from the question the kind of scenario that examiner is trying to portray, then you don't have any issue. So before we proceed, let's talk about each of the scenario. All right. The following scenario can arise. The following scenarios can arise when there is business combination through merger and acquisition. So when this happens, like I said, there are 3 different scenarios. Scenario number 1. So what do I mean by scenario? Examiner will tell you that once you can see from the question that the question relates to merger or acquisition, if the question relates to business combination, you have to consider these 3 scenarios. You go to the question and deduce what kind of scenario is the examiner trying to portray. Is this scenario 1? Is this scenario 2? Or scenario number 3? If the question relates to business combination. One of the three scenarios will be present in the question. So let me give it to you. Scenario number one. This arises where business and financial risk are expected to change as a result of the business combination. When this happens, the free cash flow to the firm, should be discounted. That's what you need to do. Should be discounted using WACOB. Let me write it out in full. Using weighted average cost of capital of the combined businesses. That is WACOB. So WACOB is WACOB is the same thing as WACOCA, right? So instead of using WACOCA, instead of calling WACOCA, you call it WACOB. Remember, WACOCA is the weighted average cost of capital of the combined activities. This one is weighted average cost of capital of the combined businesses. All right, the same 7 procedures. So under this, what are you supposed to do? Steps. For the purpose of the valuation, what are the steps? Step 1, you calculate free cash flow to equity. Sorry, free cash flow to the firm. Then step 2, calculate WACOB, weighted average cost of capital of the combined activities. Let me just mention, how do you calculate WACOB? Let me change this one to Roman figure. How do you calculate WACOB? Remember, to calculate WACOCA, I gave you 7 different steps. Step 1 is to identify. Here you identify the beta of each businesses. You know, under WACOCA, you identify beta of each activity, but here is for each combined. What is the beta of company A? What is the beta of company B? So you have identified the beta. Then step 2, you ungear the beta. If it is geared, that is, you calculate beta assets. You already know the formula to ungear. I'm not going to give you here. All right. Next step is for you to calculate market value. Calculate market value of equity. This market value is the calculate pre-merger or acquisition. Calculate pre-merger or acquisition market value of equity and debt. Then step 4, you determine weighted average asset beta or asset beta of the combined. Weighted average assets beta. All right. Then step 5, you regear. Okay. Remember, you have 2 different formulas to regear depending on whether debt beta depending on whether or not debt beta is given or debt beta is assumed to be risk-free. Then step 6, you calculate cost of equity using capping. Calculate capping. So I'm doing a revision now. I'm showing you again how to calculate WACOCA. You know, all of this, we have done it in the past. That's why I took because I know you are going to need it under valuation. I took you cost of capital for over 6 weeks, 1.5 months, just to discuss cost of capital alone. That's why we are still struggling to complete now. So it's one of the contributors for our late completion of the diet lecture. So don't disappoint me. I took my time, 6 weeks for only one topic. So no story. Then the final step is to calculate our COP. That's it. These are the steps. Each of them has its own formulas. You already know it's the same thing. All right. So that's that. Then step 3. Step 3 is to then calculate market value or present value. Calculate present value. That is market value for the initial period. For the initial period. The initial period under valuation, examiner will tell you that you should carry out the valuation maybe for the next 3 years, 4 years, or 5 years. Examiner will surely tell you that's the initial period. So then you also need to calculate the present value to infinity because it is assumed that our business will continue in operation for the foreseeable future. So you want to determine the market value of the business for the initial period, then market value to infinity. Then step number 4, you estimate present value to infinity. So calculate present value to infinity depending on whether or not there is growth in cash flow. So if, let me just give you number A, where there is no growth. So if there is no growth in cash flow, then in this case, your present value to infinity will be calculated as free cash flow of the firm, free cash flow of the base year divided by the WACC, the same WACC you have calculated in step 2. All right. So the WACC multiplied by discount factor of the base year. So that will give you the present value to infinity. Number B, where there is growth. I wish we can do calculation today, at least if it's only one. Where there's growth in cash flow, you never can tell. We can still have illustration. I should be able to finish on all the concept within the next 20 minutes or thereabout. So we spend the remaining minutes for calculation. All right, so where there's growth, then present value to infinity will be calculated as free cash flow of the base year multiplied by 1 plus growth rate divided by WACC minus the growth rate multiplied by discount factor of the base year. All right. So this is the formula for calculating present value to infinity. Then step 5, calculate corporate value or enterprise value, or you call it total present value. You're on your own, though. You're on your own, Tosin. What's the issue? You call it total present value. It's the same thing. You can call it corporate value, enterprise value, or total present value. So to do this, just add up the present value. Okay, let me just put it. Calculate corporate value by adding together the PV of the initial period and PV to infinity. Okay. So examiner will now ask you to determine additional equity value created, or it can ask you whether the company should proceed with the acquisition or with the merger. So to do this, you need to determine equity value. So to calculate equity value, let me make it the last step. Step number 6, calculate equity value. It's only in Goody book. You can see this kind of step by step. It's not in any book. Search the entire world, you can't see it anywhere. I make bold to say that. So calculate equity value. This represents, I know the student pain points. That's why I developed the golden book. So equity value represents the difference between the post-acquisition market value, post-merger or acquisition market value of equity. All right. The difference between the post-market value, post-merger market value, and debt value. So difference between corporate value and debt value will give you equity value. That is, equity value equal to total present value, which is the same thing as corporate value, minus debt value. Debt value is easier to determine. It's either examiner give to you post-acquisition or post-merger debt equity proportion, or you are given the purchase consideration, or you are given the debt, the amount of debt after the business combination. All right, so that's that. So these are the procedures you are going to carry out anytime you want to value a business, whereby business and financial risk of a company will change. So I said scenario 1, business risk and financial risk will change. I will still show you how to determine or how to identify in a question if business and financial risk will change. I will show you later on. Then scenario number 2 now. Scenario number 2. This occurs where business risk will not change, but financial risk will change as a result of the business combination. You guys are enjoying. I'm the one writing for you. That's why I love physical class, right? All this stress I'm going through is a student that will be going through, not me. I'll just sit down and be dishing out the notes. See life.
Well done, sir.
Online people
We
are
appreciate.
enjoying.
We
You are
appreciate, sir.
welcome. You are welcome. All right. So as a result of the business combination, under this circumstance, the valuation should be carried out. All of you that are running away from adjusted present value, here you have it again. The valuation should be carried out using adjusted present value. Okay. So once you discover in the question that business risk will not change, only financial risk will change, in that case, just go ahead and calculate APV. That's all. And you know that to calculate APV, what are you supposed to do? Steps. I'll just mention the key points. Steps. Step number 1, you calculate base case NPV, right? Under the base case NPV, you also have additional step. Let me call it step A. Under the base case NPV, you first of all calculate free cash flow. All right. So we calculate free cash flow. Then step 2, we calculate cost of equity on gear. Calculate cost of equity on geared. Then step 3, we calculate total. We calculate present value. Calculate or determine present value of the initial period. Then step 4, we calculate present value to infinity. Okay. Then step 5, estimate total present value or market value. Step 6, all right. Step 6 of base case NPV. Is to then calculate base case NPV. Calculate base case NPV, which represents, okay, the base case NPV represent the difference between the total present value and purchase consideration. The purchase consideration is the amount the targeting company, all right, we pay to the amount the acquiring company will pay to the target company. So that's the purchase consideration. consideration. All right. So that's your base case NPV. You keep it on one side. You then go ahead, go to step B now. Go and calculate present value of financing effect cash flow. Calculate PV of financing effects cash flow. Step C. Of course, under the PV of financing effects, you are going to consider, all right, depending on the information available, you calculate PV of issue costs, cash outflow, you consider PV of net subsidy, you consider PV of tax saved on interest. So you can have positive or negative. This is your PV of financing effects. All right. So you still remember all of this? Yes, I know you do. So that's that. Then step C now. You then calculate. No. I'll finish 11 pages. See my life outside your. Okay, let me do more. Let me clean this one first. Sorry, let me create additional pages. All right. Let me. So it's not in all cases that you are going to see all the components of free cash flow, all the components of present value arising from financing effects. It is possible examiner may not give to you issue cost or subsidized loan, but one of the three will be present in the question. Whichever one you have, just go ahead, calculate adjusted present value. That's all you need to do. Okay? So step C, calculate adjusted present value. Note, APV is equal to the corporate value or enterprise value. Corporate or enterprise value. Or you call it total present value. Total PV, total market value. Okay, so that's that. This is all you need to do. Once you discover in the question that business risk will not change, only financial risk will change, then in this case, you need to go ahead and calculate adjusted present value. All right. So I said APV, remember, APV is equal to base case NPV plus minus PV of financing effects, cash flow. So that's that. Now, the last one, scenario number 3. Scenario number 3. This arises whereby or when this arises when business and financial risk will remain constant or will not change as a result of the business combination. So when this happens, or under this circumstance, or situation, the free cash flow should be discounted using the current WACC. Using the current WACC of the business. Okay, so that's it. So once you notice that business and financial risk will not change, that is scenario number 3. So if business and financial risk will not change, you have 2 steps, or maybe 4 steps maximum. You calculate free cash flow to the firm, you calculate the WACC of the business, WACC of company A, WACC of company B, then you determine the present value of the initial period, the present value to infinity. You then match the present value of the 2 companies. You match them together. That will give you the corporate value after the business combination, or corporate value of the combined businesses. So this is what you need to do. All right. So the last time ICAN tested this scenario number, I've never seen any ICAN question on scenario number 2. Scenario number 1 was tested in 2016. Scenario number 3 was tested in 2019. ICAN has never tested scenario number 2 under valuation, which is using APV. Now, how do you determine whether business and financial risk will change? That will be our last note. Note number 1, business risk. Remember, business risk is the risk associated with the industry where a company operates, and it is measured by asset beta. Therefore, business risk will change. Okay, let me put it this way. How to identify if business and financial risk. How to identify if business or financial risk will change. So examiner will never tell you that business risk or financial risk will change. It's your responsibility. So you go into the question, go and identify from the scenario given to you, be able to deduce whether business or financial risk will change. So business risk will change if the combined businesses or let me put it, combined companies are in different industries. Okay, so company A is a manufacturing company. Company B is in oil and gas. The two of them are in different industry because the risk in oil and gas is different from the risk in manufacturing business. All right. So if the two companies are in different industries, it means that business risk will change. Or if different asset beta is given. So if you are given different asset beta, it means that the two companies are in different industry. Remember, like I said, business risk measure the risk associated with the industry where a company operates. And it is measured, business risk is measured by asset beta. So if you are given different asset beta, it means that they are not in the same industry. But if you are told in the question that the two companies are in the same industry, just like we currently have in Nigeria, whereby in the banking industry, there's a shakeup, all right? Whereby in the, I think it was started in, was it on March 2024, when the Apex Bank rolled out the recapitalization exercise that the banking industry should recapitalize. All right. So any company that cannot meet up with that cannot meet up with the deadline can be absorbed by another company. So if two banks in the same industry, all right, so they can decide to merge together. If they merge together, because they are in the same industry, it will not affect business risk. So you cannot imagine if, for example, because one of the banks could not meet up with the deadline, then a manufacturing company or Dangote PLC is now acquiring such a bank, you know, so they're in different industries. So Dangote PLC and the bank, whatever the name, so they're in different industry. In this case, the business tree will change. So these are the things you need to look out for. But if you are given the same asset beta, that means they are in the same industry. If you have different asset beta, they are not in the same industry. Then number last, financial risk will change. Financial risk will change if the business combination will result in additional debts being paid. All right. So if the transaction will involve the paying debts, so it means that financial risk will change. Remember, financial risk is the risk arising from debt financing, right? So if the acquiring company, for example, is going to pay debts as a result of the business combination, it means that financial risk will change, all right? Or examiner can tell you that the debt equity proportion will change after the business combination. Or if debt equity proportion, debt equity ratio will change after the business combination. All right. So these are the ways you can identify from the question if business risk will change or if financial risk will change. So if in the question It is possible you may not be, examiner may not, there may not be indication in the question that a debt will be paid. Certainly, it's either you are given debt value after the business combination, or you are given debt equity proportion. All right. Certainly, there will be financial risk in the question. There will be financial risk. All right. So these are the notes, relevant notes you need to, and procedures for you to carry out valuation. Remember what I told you. What is common in ICAN? The kind of valuation question that is common in ICAN is number one, asset-based approach is also very regular in ICAN. Then number two, cash flow-based approach is the most frequently tested, whereby a company will be going for stock exchange listing. Then another one may be for merger or takeover. Takeover is the same thing as acquisition. All right. So these are the likely questions you are going to meet, or scenario kind of question you are going to meet on the day of your exam. Once you discover in the question that the calculation or the scenario in the question relates to business combination, either through merger or acquisition, then you should be looking at, is this scenario 1, is this scenario 2, or scenario number 3? Once you discover that the question relates to merger or acquisition, or examiner mentioned takeover, whatever it is, once you discover it is for business combination, you have to be thinking about scenario 1, 2, or 3. Either of the 3 will be the treatment for the question. But if you are given stock exchange listing, that's very straightforward. Just calculate your free cash flow, then you discount you calculate the present value, your total present value of the initial period, present value to infinity. You add everything together, you get your corporate value. That's all you need to do. It's always very straightforward. Now, finally, at this point, we can have illustration. Before we go for calculation, maybe after our class, we are still going to have one additional discussion around this, which has to do with requirement for valuation, particularly in practice. If you want to carry out valuation, what are the basic requirements? All right, we are going to discuss it later on, but for now, let's start calculation. Let me see how many pages I have here. Let me stop sharing this and move to the working note quickly. Sorry, I said working notes, the learning material. So you go to your materials, go and read more. Go and read more about the notes, particularly if you have the golden book, then you have a valuable material with you. Okay? So let's just have one illustration that we can solve within the next 20 minutes or less. Let me see. Who says we cannot solve 2? Yeah, let's start from somewhere. What is this one saying? I think this one is for stock exchange listing. Yes, let's solve this illustration number 3. Go to page 83 in your notes, illustration number 3. Let's start from there. Yes, Usman, talk to me. Talk to me. Usman, you raised hand. Okay. I don't know if you are talking. I can't hear you. And you raised hand. Yes, who is helping us to read?
Hello, can you hear me?
Yes, go ahead. I can hear you now.
Okay, yes. I wanted to say that I know that we are guilty of, you have tried your best at taking this course. I know that we are guilty of not having enough time to cover everything as put in the syllabus by ICAN. But I wanted to say that as technical as this topic is, this topic, the business valuation, I would have suggested maybe you should give us time to digest the concept first, so that when we come to computation, we'll be able to follow you. Because this concepts, some of us are just hearing them for the first time, and we need to be able to digest them and understand them before we can follow you when we get to computation. Just a suggestion, sir.
Yeah, I understand. I understand your position. You have a valid point, though. Just like you rightly mentioned, we are pressed with time. 40 minutes is a valuable time for us to do something, and we cannot leave it just like that. We can't lose it just like that. However, as you know, this is a recorded class, so you can always go back there, start from the beginning, understand the concepts, then any example that we have solved, go through it that like we have been doing. So, but it's not difficult. It's not difficult. Just see, that's why, like I mentioned earlier, most of the work under valuation we have done in under cost of capital and under capital budgeting. We have done most of the work. All you need to do is just to calculate your free cash flow. There's not. Do you want to say that we have not done adjusted present value? Is it that we have not calculated WACOCA or the normal traditional WACC? All of this we have done it in the past. So there's nothing new, except for the fact that you then have to match everything together when you are doing your valuation. But I can bet you don't have any cause to worry. Yeah, you don't have any cause to worry. It's very straightforward. By the time I begin to solve question, in fact, the way you are saying it that, oh, let's digest this one. Some of you will be saying, oh, let's try it. Let's see how it will work out. All right. But again, we are pressed with time. All right. So when you get later today, I will share the working notes. You'll be able to go through all of them together. All right. Sorry, we just have to do calculation. Otherwise, we are going to be taking classes in the month of May, and I want to avoid that. All right. I want to avoid that. You need time to practice on your own as well. Yeah. Okay.
Okay, sir. Thank you, sir.
You're welcome. Yes, who is helping us to read? Lamborghini Limited, illustration number 3, page 83. I'm not going to solve a technical question. So that's what I'm starting with this one. This one has to do with stock exchange listing. Yes, where is Tosin?
Good evening, sir.
Yeah, good evening.
Thanks,
Go
sir.
ahead, please. Help us.
Lamborghini Limited, a food packaging company, has operated as a private company for the past 10 years. The company has been growing rapidly over the last few years. The directors are now considering listing the company on the stock market. Preparatory to this, the directors are interested in determining a fair price per share for the company. Assume today is November 1st, 2016. The following information has been extracted from the most recent audited financial statement of Lamborghini Limited. We have the statement of profit or loss as at October 31st, 2016. All figures are assumed to be correct. And we also have the statement of financial position as at October 31st. We have for 2 years, we have the 2015 and the 2016 year. So the following additional facts are available. The directors believe that the free cash flow to equity model should provide appropriate valuation for the company's shares. An investment banker has provided the following estimates of cost of capital. We have the cost of equity being 15%, post-tax cost of debt 4%, and WACC 12.5%. The directors believe that the free cash flow to equity will grow by 18% for the next 5 years and by 5% thereafter. The company currently has 600 million shares in issue. Required. Calculate the free cash flow available to equity for the year ended October 31st, 2016. Use free cash flow to equity model to calculate the current value per share. What are the key advantages and disadvantages of stock exchange listing?
All right, thank you very much, Tosin. That is the question. Yes, 20 marks when the question was tested. So you are required to calculate because of time. Let me just stop sharing this and move to the working notes so that within the next few minutes, we are done. And then, if possible, if you still have time, you can take one more. So solution. So illustration 3. That's page, is it 73? Let me confirm. Page 83. The name of the company is Lamborghini Limited. The first requirements, according to the question, we are to calculate free cash flow to calculate free cash flow available to equity for the year ended 31st October 2016. So we want to calculate free cash flow to equity. I would then say calculating free cash flow to equity, FCFE. So you have to be very careful. Here, examiner was specific. You have to calculate free cash flow to equity, not free cash flow to the firm. Therefore, our figures are a million. So how do you then calculate free cash flow to equity? I gave you 3 different formats. One of the formats should be used for your calculation. So we go to the question, go and check income statement given to us. In the income statements, we are given earnings before interest and tax, which is profit before interest and tax, 1836. We're also given profit after tax, 1054. So profit after tax will be faster. Therefore, just pick your profit after tax, 1054. I will then come here, profit after tax, 1054. Immediately after profit after tax, what do? You add back non-cash item.
Depreciation.
All right. So depreciation,
440.
440 is the depreciation. Then you consider changes in working capital. Before you put it down, before you write changes in working capital, you go back to the question and check if truly there is a movement in working capital. I believe you guys have done IS7 or group accounts, group cash flow, right? So you would have been taught how to check for movements in working capital. You know, there are 3 changes, there are 3 phases of your IS7 statement of cash flow. We have cash flow from operating activity, cash flow from investing activities, and then cash flow from the financing. All of them will be present when you are calculating your free cash flow to the firm. All right. So now you want to determine when you are calculating your free cash flow, rather. So you want to determine whether there is movement in working capital. Remember, working capital represents the difference between current asset and current liability. Okay, so in this particular question, you are given 2 periods. Cash flow from 2015 and 2016. Financial information from 2015 and 2016. So you are given balance sheets. So from this, you'll be able to see movements in working capital. So I need to go and do working for that. Page 1, page 2, then my working will follow. Let me see if I add additional space. This should be okay. So my working will follow. So let's say my working will start from here. Working number 1. I want to determine if there is changes in working capital. So you can come here, changes in working capital. You know, I told you the other time, because of time, I could not give you the format to do that. So I said we are going to use calculation to demonstrate it. And you know that working capital equal to current assets minus current liability. So you want to know if the company has incurred additional working capital or more cash has come in. You want to know whether cash has gone out or cash has come in during the period under consideration. So we have 2015, 2016, and then change. What has changed between the 2 years? All right. Our figures are in millions. So I will then go to the question. Under current assets, what are the assets you have there? Give it to me. In 2015.
Cash and bank.
So when you are calculating working capital, you don't include cash. Next
Account
one,
receivables.
receivables. So I will then come here, receivables. In 2015, what's the amount?
980.
980. In 2016,
1072.
1072. This means that more cash has gone out. The customers has taken more goods. So more cash has gone out. So that's an increase in working capital. So what's the difference?
92.
92. That's a cash outflow. Put it in brackets. After receivable, which one is next?
Inventory.
Inventory. In 2015, how much?
2078.
30. Okay, 2078. Then 2016,
2542.
2542. So it means that the company has purchased additional inventory. More cash has gone out. In 2015, the company has inventory of 2078. In 2016, inventory has increased. That means company has purchased more inventory. So cash has gone out. What's the difference?
464.
464. It's a cash outflow. After inventory, what's next?
We have total current assets, total assets, equity and liabilities. Now, non-current liabilities. Current short-term loans.
Short-term loans will come under financing.
Account payables.
So payables. In 2015, how much?
2792.
2792.
92.
In 2016,
3084.
3084. So the company was owing suppliers or creditors 2792 in 2015. More cash has come in between the two periods. So now it has increased to 3084. So what's the difference?
292.
292 is positive. That's positive. So when your creditors increase, that means more cash has come in. More goods has been taken from supplier. All right. So once your creditors increase, it means that it's a positive cash flow. All right. But if your payables reduces, it's a cash outflow. That means you have settled your supplier. So my focus is on the total change. I'm less concerned with individual year. If you do for individual years, so be it. So what's total change? What's the total?
Minus 264.
Minus 264. So that's an increase in working capital. So I will then come back here from my table. I will say changes in working capital, or you call it increase in working capital. Working number one. 264. So cash outflow. Then after this, we need to consider whether additional non-current asset has been purchased. That is capital expenditure. Capital expenditure. So to do this, we go back to the question again in the balance sheet, in the statement of financial position. Examiner has given you information about non-current assets. Current asset, non-current asset for 2015 and 2016 are different. So that means there is a change in non-current asset. Additional non-current asset has been purchased. So we need to go and do working for that. So to do this, I can either use a formula or I use T formats. Remember, we want to determine whether additional non-current assets has been purchased. Okay, I can either use a T format or I use a formula. So if I'm using a T format, remember, asset is a debit balance. So I will then come here, balance. Let me go to the next line. Balance brought forward, 2015. Then we are going to have balance carried down, 2016. So the non-current asset given to us in the question, what's the non-current assets in 2015?
5942.
5942. Non-current asset in 2016?
6224.
6224. Then you then had POL, profit or loss account, depreciation. So POL, that is depreciation, which is 440.
440.
So this will give us 6664. So 664 minus 5942.
722.
722. That's additional non-current asset purchased. So this will give us 6664. Alternatively, if I want to use formula, I can say additional non-current assets or addition equal to closing non-current assets plus depreciation minus opening non-current assets. We still get the same thing. Here will be 6224 plus 440 minus 5942. So we are going to have the same thing as 722 million. So whichever one that is more convenient for you is what you should use. Okay. So we have additional non-current asset of 722. It's a cash outflow. Capital expenditure. Working number 2. 722. Then, after this, we also
Loan
need to
repayment.
consider if there is loan repayment. So before you put it down, you need to go and check. So let's check if there is additional loans. Working number 3. Let me use this space. Additional loan. We want to know if there is any loan repayment or the company has gotten additional loan. So for 2015, 2016, then change. So in the question, we have non-current liability, right? Bond.
Yes.
How much is bond in 2015?
2,500.
2,500. In 2016?
2,400.
2,400, which means that cash has gone out. The company was owing 2.5 billion in 2015. In 2016, it has reduced to 2,400, 2.4 billion. That means cash has gone out. The company has used cash to settle the debt holders. So the difference of 100 is a cash outflow. Next one. We also have short-term loan, Abi.
Yes.
Short-term loan. In 2015, how much?
1,432.
1,432. 2016.
1,936.
So the company was owing 1,432 in 2015. The owing has increased to 1,936. That means more cash has come in. So that's a positive. What's the difference?
504.
504. That's it. So let's find the change. My focus is on the total. So the difference is 404. Positive. More cash has come in. So that's positive. Additional loan has been gotten. So it's a positive. So I will then come here. Additional loan. For working number 3. 404. So let's find the difference. That will give us free cash flow to equity. Total. Yes?
912.
912. So that represents the free cash flow to equity. 912 is the free cash flow to equity. 7 marks, you pocket it. Move to number B requirement of the question. So in number B, you have to determine current market value per share. We want to calculate current market value per share using the free cash flow to equity model. So I will then come here, calculating market value. Remember, market value is the same thing as present value. Our figures are in millions. All right. I will then go back to the question. What's the initial period? How many years? According to the question, we are told that
for the next 5 years.
For the next 5 years, we are told that the directors believe that the free cash flow to equity will grow by 18% for the next 5 years. So 5 years is the initial period. All right. 5 years is the initial period. Therefore, I will then come here. When you are calculating present value, you don't include year 0. So no need for year 0. So I will do for year 1, year 2, year 3, year 4, and then year 5. I will then pick my free cash flow to equity. The current free cash flow to equity is 912. We are told that it will grow by 18% for the next 5 years. Therefore, This 912 is the current value. So you start inflating. You then carry your calculator. 1.18 multiplied by 912.
1076.
1076. What you have in your calculator multiplied by 1.18.
1270. Approximately 1270.
So what you have in the calculator multiplied by 1.18.
1498.
Multiplied by 1.18.
1768.
Multiplied by 1.18.
2086.
2086. So this represents our free cash flow to equity for the 5 years. So the next we need to do, remember, this is not about business combination. This has nothing to do with, since it's not business combination, there's nothing, you don't have anything to do with scenario 1, scenario 2, or 3. All right, so this is just for stock exchange listing. Therefore, after you have computed your free cash flow to equity, the next thing you need to do is to then discount at the appropriate, using appropriate discount rates. According to the question, you are given cost of equity of 15%. You are given post-tax cost of debt of 4%. You are given a WACC of 12.5%. You have to use apple for apple. Since you have calculated free cash flow to equity, you have to use cost of equity. If you have calculated free cash flow to the firm, then you can be using WACC, right? So we are using 15% at 15%. So discount factor for year 1 at 15%. What do you have there? Let's move faster.
0.8695.
8687. 3 decimal points.
Yeah?
3 decimal points.
It's
Next.
0.756.
Next.
0.658.
Next.
0.572.
And then
0.497.
497. So we then determine the present value. Valuation is not difficult. It's only that if you don't know the concept, if you don't understand the procedures, you may struggle. Give it to me one by one.
936.12. 936.
Next.
960.12. 960. 986.
Next.
1011.
And then
1037.
so this represents the present value for the initial period. Therefore, let's add everything together. Present value of year 1 to 5. Add everything together.
4930.
4930. That's the total present value for the initial period. We then need to calculate present value to infinity. Present value after year 5 is year 6. So we calculate present value from year 6 to infinity, which is the free cash flow to equity of the base year. We are given growth rates after year 5. So multiply by 1 plus growth rate divided by cost of equity minus growth rate multiplied by discount factor of the base year. So here is equal to Now, what's my free cash flow to equity of the base year is the year before, year 6, which is year 5. Whatever value that you have here, that's your base year. So which is 2086. And we are told that the free cash flow will grow by 2 points, will grow by 5%.
18%.
We grow by 5% after year 5.
Okay.
So here will be 1 plus 5% is 1.05 divided by cost of equity of 15% minus the growth rate of 5%. Discount factor of the base year is 0.497. That is the discount factor that you have here in year 5. Therefore, what do you have here? Equally, 2086 multiplied by 1.05 equal divided by 0.1 equal multiplied by 0.497. What do you have?
10,886.
10,886. We then add everything together. Plus 4,930.
Fifteen 816.
816. That represents the total present value. This is the total present value or market value, or you call it corporate value. All right. So examiner is asking us to calculate current market value. Therefore, current market value would then be equal to total market value divided by number of ordinary shares. So total present value is 15,816,000,000 divided by total number of ordinary shares, which is 600 million shares. Therefore, what's the current market price per share? Tosin, are you still there?
Yes, I'm with you.
15,816 divided by 600.
Oh, divided by 600. Sorry. 26. 26,359.6.
2636.
Yes.
Per share. So I can then say the current market value. Let me check the requirement again. You have to use the free cash flow to equity mode to calculate the current value per share. Okay, the current value per share. The current value per share is 26 naira 36 kobo. That's it. That's the end of the question. So examiner is asking you for advantages and disadvantages of stock exchange listing. So you can always get that in your Pathfinder questions or in your golden book. All right, they are pretty straightforward. So this is where we are going to call it a day. Let me know if you have any question for me before we close the class. Any question? Any question for me? All right, so please, I want to advise you. So like you're already aware that like I mentioned earlier today, and we have been saying it for a while now, valuation is a very frequent question in ICANN. You can't run away from it. All those things, if you have been running away from adjusted present value, for example, you just have to change your mind, all right? So go back to the basics. Go back to the basics. All those things that we have been doing in the past, ensure that you understand them. So because if you don't understand the fundamentals, you are going to struggle as far as valuation is concerned. So most of the question under valuation in recent times has been 30 marks. All right. So you don't want to joke with that. Therefore, I will encourage you, go back one by one. You still have sufficient time, one by one. Take your time, understand the concepts. All the concepts I've explained today under valuation, go back to it. If you have your golden book or any other textbook that you have on valuation, go and read them through. Gain more insight, gain more insight. Then begin to practice questions. So out of 5 or 7 questions we are going to solve, we have solved one. One is gone. So we have 6 or 5 more to go. All right. So in our next class, we continue from where we stopped. All right. So again, please, you are getting closer to the D-Day. Your exam is about 28 days now to the D-Day. You can imagine, it's fast approaching. Judgment Day is right at hand. My people, please, all eyes are on you. Don't disappoint us. Don't disappoint us. You have to make your effort count. Your effort of every night attending classes, you have to make it count. And your effort can only count if you succeed, if you move to the next level. Therefore, you have to work. You have to work harder for you to be able to achieve a beneficial outcome when your result is released. Based on the experience, ICANN May Diet is usually released the last weekend, the last week in the month of June. So you can imagine, so that clear all your papers, qualify this diet, so that if you have the required or the requisite work experience, then in November, you go ahead and receive your certificate. That's end of your ICANN journey. You move to the next chapter in your career. So that's what you should be working out for. All right. That's what you should be working. That should be your target. Please, I beg of you. You still have sufficient time. You still have sufficient time for you to do well in your exam. And this is the same thing we've been shouting since January. Aha. So please go back. Start as if you are reading afresh from the beginning. Understand all those basics across all the subjects, all the topics and subjects, so that at the end of the day, you are going to have every cause to say, God, I thank you. I'm now a qualified accountant. By November, you receive your certificate, you become a chartered accountant. Then you move on from there to the next chapter. Thank you, everyone. I will see you next time by the grace of God. Good night. Bye-bye.
Good night, sir.
All right, good night.